There's really four types of loans, and I apologize, I'm not very tech savvy, so I'm just going to go old school and just talk to you. There's four kinds of loans. VA, do we have any veterans in the house? Anyone that was in the military? Okay, so that makes it really quick and easy. VA loans are just for people that have retired from the military or have left the armed forces with an honorable discharge. Maybe you know someone in your family that is a vet. The great thing about VA loans, it's 100% financing. The government backs you because of your service. So it gives you the opportunity to get a home with no down payment. Another one that actually gives you a home with no down payment is USDA. Anybody been to the grocery store lately? Gone down the meat aisle? You seen the stamps USDA? Same company, same arm of our government. It's geared towards the sticks. I was picturing more of a rural setting for myself as I've been in the suburbs for far too long and I'm burnt out. I'd like to see the stars and not my street light. But that's just me and that's my vision. So USDA is a program that will provide 100% financing and they'll work with credit challenged individuals. And the reason is they want to get people to move out. Sometimes areas get congested and sometimes it's hard to grow areas if there's not enough people. If there's not enough people, there's no need for a grocery store. There's no need for a grocery store, then there's not a need for people. You know, no one wants to drive 20 minutes to go shopping. So just to kind of give you some ideas of what makes a property rural is based on the last Census Bureau, 10,000 people or less live in that town. You get a lot more house for your money when you go out rural, but then price of gas, you got to drive. So, you know, at the end of the day, it depends on what's more important to you, you know, the time or money factor. Conventional is geared towards generally people that may have already been a homeowner. The mortgage history, if it's strong, does a lot for your credit. It builds it up quite a bit. Conventional is generally geared towards individuals that are looking to make a sizable down payment, or the minimum really is 5%. They have a new product that will allow you to do 3% down. I don't want to just say that there aren't options, but to get 3% down in a conventional realm that's geared towards higher credit score individuals isn't always the easiest task for a loan officer to present. But conventional is a great product. They have lots of different ways that you can utilize the rules in the favor of the buyer by putting in second mortgages or putting in mortgage insurance. I don't want to complicate things too early on in the phase. I just want you to know that if you have really good credit or you've saved up a good amount of money, conventional might be a product that we will discuss. But the fourth and final product, which is generally geared towards the first-time home buyer, is FHA. So FHA loans are going to be probably the more flexible products out of all of these. You can buy a home anywhere in the state of Texas with FHA. No real restriction on income. So there's no issues with how much money you make, too much or not enough. There's really nothing about that program that's going to determine that I should be in FHA or I should not, other than your credit score. Credit score minimum requirements within our company for an FHA loan is a 600. Now 640 is where I'd like to see you. It opens the door to many other things that FHA will allow for. FHA does have some limits on how much you can be lent. $310,500 is the maximum loan size. So it's not for everybody. You know, some people want to buy a $500,000 house. Well, they can't, not with FHA anyways. Not unless they want to put down, you know, $189,500. So FHA is going to be geared towards your first-time home buyers. They will allow for some flexibility. Your down payment can come from a gift from a family member. Your down payment can come from an organization, maybe a church, maybe a state-based organization. Down payment assistance is what it's also known as, DPA. And we're going to get into that at the end of my speech. FHA has that flexibility on the credit scores as well. So I think that ends up being the reason why a lot of first-time home buyers go there is because they've got an issue. Maybe it's the money down, maybe it's the credit. They're going to be able to get to FHA qualification much quicker. So what are banks looking for to get a home loan, to get money for a house? Pretty simple, really. 2-year history is what we're going to look at. We're going to focus over your last 24 months. Specifically your residence history. So how long have you been living where you're living? Employment history. We're going to look at the last 2 years. So what have you been doing for the last 24 months? Big hurdle is if you haven't been doing something for 6 months or more during that 24 months, if you haven't been working. so what we call a job gap. So we're going to look at 24-month history. And when we look at that history of where you're working, we want to know kind of what you do for the company and what your role is. We send out an employment verification. They're going to tell us a little bit about when you got your last raise, when your next raise is, what's the likelihood of your continuance there, are you eligible for overtime, bonus, commission. There's lots of different nuances to how you earn your income. And that's the next piece that we look at when we do a loan application. So we're going to look at your income. How do you earn your income? The more stable your income, the better. So your hourly wage earners, real simple math. You make this much dollars an hour, you're guaranteed this many hours. I multiply those together by the weeks in the year, I divide it by 12, I've got a number. And I can bank on that number. And banks want to have some consistency when they decide to invest with you in that home that you desire so much. Now, if you're earning income that's commission-based or overtime or bonus, we want to see a history of that. We want 2-year history of overtime. We want to see what a good year looks like and what maybe a bad year looks like and blend them together. Sometimes overtime is seasonal, depending on what type of work you're in. You may work a little bit more during one time of the season than another. So if you've been on your job for a year, overtime income, it's great to know that you have, but the bank's not going to use it to help you qualify for a home. Okay? We're going to also look at credit. That's the big one that I think a lot of people really left in the dark about. So we mentioned 600 is kind of a minimum credit score we'd like to see you have. 640 is really a benchmark that you should strive for. There's 3 scores that we get, one from each major bureau. Does anyone know the names of the bureaus? Experian, Equifax, TransUnion. All right. You don't have to have 3 great scores. You just have to have 2 really good ones. The low score we're going to ignore. The high score we're going to ignore. We're going to shoot for the middle. Okay? What's important about credit? A couple things. Your pay history, obviously. How do you pay your bills? You pay them on time? Do you have open and active credit? Are you utilizing credit on a day-to-day basis? I know cash and carry is great. No stress, no worries. No one's going to bother you. No late fees, no interest. But if you ever want to get credit, you have to have credit. What else are we looking for in a loan application? Debts. What's open? What's active? Now, a debt is not a utility bill. A debt is not a cell phone agreement. A debt is something that's going to be on your credit report, like a credit card, a student loan, a car loan. Those are debts that are going to show up in your credit report. Okay, and that's what we calculate the DTI. Debt to income. So what we do is we take your gross income, what it looks like before the government takes a piece. And then we're going to look at your debts. Car payment, student loans, minimum payment on your credit cards. Not what you pay, but what's required. Mostly you'll see $25, maybe $100. And then what is your proposed housing payment? How much of a mortgage are you asking for? And if you don't have a clue, I'll plug it in. And I'll tell you what you're allowed to afford. What you're allowed to afford and what you buy are always going to be something different. I don't push people. I'm not here to sell you anything. I'm here just to educate you, give you the information, let you do something with it. So we'll take all your debts, proposed housing payment, plus your minimum payments on your credit report, on open actives. Plus, if you have a bunch of collections, I got to add those together, do a 5% of that amount, and create a little payment there, unless you set up a payment arrangement with those collection agencies for less than that amount. And then I divide that into your gross income. We talked about income earlier. 2-year history on any kind of income that's not your salary or your hourly wage that's guaranteed. And I divide those two together, and that gives me a ratio. And we want to keep your ratio at a certain position. The industry is pretty loose right now. They'll allow you to afford a lot more than they would in the years past, like up to 55% debt to income ratio in FHA in some cases. 45% is probably a more comfortable place for a lot of people. I would actually like to see most people no more than 36% if I can coach them into it. Last thing is assets. You got to have money to get money, unless VA or USDA, as we discussed. Okay. Down payment assistance. Here's the big one. This is what I like the most about my job. The state of Texas has some programs that will help you get some free money. Nothing in life is free, and I guess you're right. That's probably what you're thinking. This particular program that I'm first going to talk about is called TSHAC. It stands for the Texas State Affordability Housing Corporation. Don't write it down, just say TSHAC. TSAHC. This program is geared towards what we would consider a civil servant. However, they can't discriminate. They can't keep non-civil servants from being able to apply for this grant. So you can be anyone as long as you're a Texan, and you can have access to up to 5% of the sales price to go towards your down payment and your closing costs. You have to have a 640 credit score for the middle. Your debt to income ratio cannot exceed 45%, period, end of story. And there's going to be some income limits. We look at the income for the household. So this is geared towards your moderate to median income. Just to kind of give you an idea, since no one in here is a special job title, the household income, $56,320 a year. If you're making $56,320 a year in your house or less, then you can get this grant. A grant means you don't pay it back. It's your money. You get it the day of closing. It covers 3.5% for the down payment. It leaves 1.5% left over for closing costs. It's not enough to cover all the closing costs, and that's where Winomogram is going to be able to help you negotiate. That's where Ms. Leah Rufus is going to step in and talk to the seller and say, we need a little bit of help. And if they can't negotiate the help that they need, then that's where you have to be prepared to have about $2,000 of your own money prepped and ready to invest to cover the gap between what the state's giving you and what's required to buy a house. Okay. Now, you may be saying, well, my household, my spouse and I, we make more than $56,000 a year. That's okay. There's another program for that. It's called the Seth 5-Star program. And they'll give you up to 5% towards the purchase of a home. Their income limits, and they just were increased in March. Cost of living is going up, so pay is supposed to as well. I hope that's happened to all y'all. $80,960 a year household income combined. And you don't have to purchase in any special area. You don't feel like they're going to force you to go buy this part of town or that part of town. You can buy anywhere in the state of Texas. And the Seth program, you can be anybody. You don't have to be a firefighter or a teacher. Seth, since they're a little bit more lenient in the income, they charge an extra fee. It's 1% of the loan amount. So let's say you're getting a $150,000 house. You're going to need that $2,000 from the seller, ladies, and then another $1,500. Because Seth has what we call a participation fee. But they're going to also allow some of the people that make more than $56,000 to get access to money that they wouldn't be able to because of that other program has limits. And so that's what I really love about this other program, Seth 5-Star. So that's how we deal with assets. You know, if you have your own money, great. Let's use it. These down payment assistance programs, the interest rate is generally 0.75 to 1% higher. So today's rate, let's say, is 4. These programs, they charge 5. What are you going to need to provide? 30 days of pay stubs. I'm going to look at the last 30 days. 2 months of bank statements. I want to see kind of what's going on in and out of your bank account. 2 years of tax forms for the W-2, which is what your employer provides you, and the 1040. Hopefully the easy form. Since you guys are not homeowners, you're only having to fill out that 1 or 2 page tax form, the 1040. So tax returns and the W-2s. I want to make sure they match. I want to make sure that what you're telling the IRS is what you're telling us. The retirement accounts. If you have a 401k, we want to look and see what you have in savings from a retirement perspective, because that's for rainy day. And that's really it. Now, if you've had a bankruptcy or a divorce or child support, we're going to want those legal documents so we understand what happened there and if there's any obligations associated with a separation. If you're getting child support, we would have to have 3 months of concurrent child support payments to show that that's an income that you're receiving. And if your student loans are in deferment, that's the one last thing I didn't talk about. Student loans in deferment, we want to find out what the future payment is. If that future payment is coming due in the next 12 months, we have to consider that as a possible payment. You can push your forbearance out if it's eligible, and as long as 12 months from the day you buy a house, you don't have to make a payment, then I won't count that debt against you. But I would prefer to know what your future payments are supposed to be to make sure we're not overqualifying you, because eventually you're going to have to pay those student loans back.